Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 78 unit building, 5 minutes from the Kentucky Derby. Its rents are presently 20% below market for renovated units. To learn more, all you need to do is go to homeinvest.com or click in the description below. Always consult with a tax advisor, financial planner, and/or attorney before making investment decisions. Having said all that, all you need to do to learn more is go to homeinvest.com or click in the description below.
Today on Purpose Driven Passive Profits, we are going to be talking about how you can save money on your taxes. If done correctly, you will legally never pay taxes again. All right, guys, let's jump into it. If you don't know, his name is Nate Armstrong. He is the CEO of Home Invest. My name's Steve Warner. I'm the Chief Investment Officer at Home Invest, and we are here today to talk about taxes, how you never have to pay taxes again if done correctly. And this is for passive investors, people who are invested passively in multifamily real estate. So Nate, this is one of your favorite topics. Last year, you actually got a return, correct?
Yeah. In to some people that might not sound like very much, but like just keep in mind, like God has blessed us on the finance side. Like we had one of our best years actually last year. So for us to get a return, it's not supposed to happen that way. But it is, because the tax code is actually a behavior modification program. It's their plan. It's the IRS. It's the government's plan to get you and I to do certain things, whether we like to or not, through these tax codes. So I'll unravel some of those today.
Okay, so let's go ahead and jump into it. If somebody is passively investing, they're coming into one of our deals for maybe 100, maybe 200, maybe $300,000. What kind of tax savings is that going to get them against their personal income?
Yeah. So I'm going to probably take this to a 10,000 foot level and then drill down on it. Backing up first is it's always a good clarity to know where the funds are coming from. A lot of people that come to us, they're either coming from a retirement account, like an IRA or a 401k. By the way, those of you that have like an IRA or a 401k that is sitting in maybe your previous employer's program or in the stock market, taking a hit this year, sorry to say, it's just reality. You can move it out and you can move it into real estate. That's something that we've helped a lot of clients be able to do. But we have to know the source of the money first. So if someone's coming from, maybe they sold another rental property that they had, and now they're trying to passively invest, first things first, they can do a 1031 exchange. That means that basically they take the money, they reinvest it into a new deal, and then they defer paying all capital gains tax. That's one way to do it. An even more creative way is that before you sell the property, you can actually pull a line of credit out against the property, pull out all of the equity from it, and then complete the sale. And then when you pull that money out through that line of credit, anytime you take a loan against a property, that's actually tax-free money, totally tax-free. And so sometimes we'll get people that come to us before they sell, and they'll ask us like, hey, how should I structure this? I would look at that first. I would say, hey, jump on a 15-minute phone call with us and let us dissect what you got going on. And if you've got equity that's sitting in something, you might be able to take that equity out now and then use that as an investment into one of the funds or the syndication deals and things like that. So that's before the investment even starts. That's all pre-investment ways that you can minimize or not pay tax at all. Now, we'll jump into the actual deal. Let's just say that we invest in this deal. What tax breaks can I get? Well, if someone is actually working real estate full-time, or they have a spouse that's in a position where they can work full-time as a real estate investor, there are some pretty massive benefits that go on. Like we have a doctor client, he's been investing with us now for going on 9 years or so. His wife formerly was a stay-at-home mom. And what she ended up doing is she is the one that looks after their real estate investments. And so she was able to qualify for that real estate investor professional status. And so therefore they're able to pick up additional tax breaks. Steve, should I drill down? How far do I go?
Let's talk about that one just a little bit. When we say like they're a real estate professional, some people might hear that and they're like, oh, I don't know. Is it worth it?
Yeah.
What kind of difference is it going to make As a real estate professional, how much tax breaks are we talking about here? Is it like an extra 5% or is it like an extra 30%? Let's go with
Well,
that and then dive into what it looks like.
depending on someone's income, it could be an extra 30%. It could be the thing that takes you from having to pay 100 grand in taxes to getting a refund in taxes. So as an example, we purchased one building at the end of last year. We purchased other ones too, but one right at the very end of last year. And I remember this one specifically because we got a professional tax person to go out and do a study of this building called the cost segregation study. And when they came back, the cost segregation report study said that we were eligible to get a deduction on our taxes of $987,000 per year for 5 years straight. And so I got that right before the end of last year. And I'm like, holy cow, this seems really juicy. This is like really big. Now it's all passive deductions. They call it passive losses. They're not really losses. You're not actually losing money on the investment property. What's happening is that the government says this asset is going to wear out over time. We recognize that you're going to have to put a new roof on. You're going to have to put windows in, blah, 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 all that stuff. And what they allow us to do on multifamily real estate is instead of deducting those, they call it depreciation, taking that depreciation over a long period of time, we can accelerate it. We do accelerated depreciation and we can take credits for all of that stuff right up front. So those amount to what would look on paper as a passive loss. It's just a big fat tax credit for those of us that are eligible to claim it on our taxes. Usually folks that are, that they can have that designation as a real estate professional, those are the folks that can really max it out.
Okay. So let's talk about one more thing inside of the real estate professional. Let's just say, what is that and why? So the doctor, you gave the example of the doctor and his wife. Why couldn't the doctor be a real estate professional?
Yeah, great question. Because that real estate professional tax law, they've got some limitations around it. They can't just, like, if one of them is if you earn your primary income doing something else, they're not going to let you claim that as an individual. Now, your spouse could, like in the doctor's case, his spouse wasn't making income elsewhere. The other one is, where do you spend the majority of your working hours? And if you can't classify and say, hey, the majority of the working hours where I make money is real estate, then they're not going to let that fly. Now, there is there is this one big exemption. It's actually in short-term rentals. You guys can Google search short-term rental tax exemption, and it'll pop up all over the internet. The funny thing is that this tax code allowing people that owned a short-term rental, just literally one short-term rental could possibly qualify you for this. But the tax code that allowed people with a short-term rental to get real estate professional status actually it was popularized during the 80s, it was a big hotel era. A lot of people were taking advantage of it. They'd buy into a hotel to get the status. Well, fast forward 20 years, short-term rentals got popular and a lot of people run them like it's a mini hotel, tiny little hotel. It could be a 1-bedroom condo downtown. Anyways, because of that exemption, a lot of people, they'll buy one single short-term rental in order to pick up that real estate professional status. I'm not saying that you should go out and do that. I'm not for that or against it. Like, that's an individual kind of conversation because not everybody has the same amount of time and resources and knowledge and all that kind of stuff. But that is something I've seen become really popular. People are taking advantage of that.
Interesting. I mean, that might be a loophole that closes eventually.
I suspect, yes.
If we bring this back to syndication wise, though,
yeah,
let's say that it's, I don't know, let's say that there is a consultant out there that makes $250,000 a year and he has a stay-at-home wife. His stay-at-home wife stay-at-home partner could end up coming into this and becoming a real estate professional by investing passively in a syndication deal or in a fund deal. Is that correct?
Yeah, they certainly could invest passively into fund deals. They could do active, they could do either way, but yes. Yep. Exactly. Now, if I could for a moment, Steve, let's just pretend no one qualifies for that. You can't get the investor professional status real estate professional status. There are other tax benefits to investing in real estate. Actually, real estate and then gas and oil are like what the government really gives us the most, in my opinion, the best benefits to invest into. Okay. So what else can you get out of doing a real estate deal? Well, number one, any profit that you make from passively investing in that deal, you could set it up so that you never pay tax on it, like literally never. And the way that you do that is that when the profit check is about to come, you say, you know what? I don't want the profits from this. I want to roll those into the next deal. That's commonly known as a 1031 exchange. And so you could do that forever. You could just keep doing it over and over and over again. And before we jumped on together, I remember one of the questions you had asked me is you said, well, hey, can anyone, if you're going to do that rollover, can you still access the money somehow? Is there a way to pull that cash out? And the way that you can do that, yes, is the answer. The way that you can do that is that instead of just injecting it into another fund or syndication, you can go and buy your own multifamily property, and then you can take a loan against it later, and you can pull out 100% of the equity that's in that property, tax-free, without paying any tax on it. And so I know that this is getting into a little bit of like technical stuff, but if anyone like wants to dissect this, the most appropriate thing to do would be to jump on a 15-minute phone call and just talk about this stuff. Ask, like, I know our team does those for people, and it's why a lot of investors choose us, but I'm happy to help tackle those kinds of questions too.
Awesome. Last thing I'll finish up with, Nate. If somebody's thinking about doing this, they should definitely jump on a call with us. If they're doing it inside of a retirement account, so let's say they have a 401k or an IRA that they're rolling over and they want to invest in a syndication deal, how do taxes work in that? Because when they sell it, that money rolls back into their retirement account. Like if we took their money into a fund 5 years from now, that fund matures, they end up getting a profit check. How does that work? Are they 1031ing that? Is it doing something different? Walk us through what that looks like so people understand how positively this will affect their retirement accounts.
Great question. So if their money is coming from a retirement account, and then they put it into this deal, and then this deal turns around and makes a bunch of profit, they won't have to do a 1031 exchange because their money, all of the proceeds are going right back into the retirement account. And so let's just pretend that they invested that money from their paycheck at work or into an IRA that they already paid tax way back then it gets to grow tax-free. Like there's no extra tax bills they're going to have to pay on it. And so from our end, like we're going to send the money back to the retirement account every single time. So they won't have to worry about doing a 1031 exchange. They could grow this thing and multiply it to infinite levels. Now, if I could throw a cautionary thing for folks, if you're going to use a retirement account and you're going to do something like flip houses, that would be something that I would draw a huge red flag on. I see a lot of people make the mistake. They jump in and they're like, oh, I'm going to use my retirement account as a self-directed IRA, and then I'm going to invest it into house flips. The thing with house flips is that because the government sees that there's constant turnover happening, they're going to come and slap extra tax in the middle. They're going to put something called EBITDA tax on it. And instead of doing a house flip, get into these longer term apartment buildings, multifamily syndications, multifamily funds, and then you can avoid getting slapped with that tax.
Awesome. Good advice right there that will save you from making a blunder. I've seen people do that as well. One guy that was in one of my real estate investment groups way back, he actually did that with his retirement and he got hit with it and he had no idea. And it was because his accountant at the time had told him, like, this is probably the fastest way that you could grow this. So he started doing flips through it and it ended up burning him in the end. So very good advice there. If you guys want to learn about our current offerings, we have a fund that is getting started. This is going to all go around the thesis of value add. We buy buildings that need the rents raised. We come in, we raise rents, we make improvements, we build communities, and then we exit those. That fund is kicking off. You can click below homeinvest.com to learn more about that. We also have multifamily syndication deals going all the time as well. You can learn about our current offerings at homeinvest.com. Nate, anything I missed?
No, sir. Just be tax efficient, ladies and gentlemen. We can all kind of guess. We just got done watching the debt ceiling get settled out, and they increased it again, which means that our futures are being borrowed upon right now. So just you can imagine what will happen with taxes as we go into the future. So try to get tax efficient. You can't get very tax efficient in the stock market, so I highly recommend getting into real estate.
All right, guys. Until next time, make sure that you are wise in your investments, and we will see you here at Purpose Driven Passive Profits.
Bye, guys.
Thanks so much for listening to our show today. Here's Nate with our latest offering.
Oh, so I'm excited to announce this. We've got a 78-unit building, multifamily property. It's 5 minutes from the Kentucky Derby. Its rents are presently 20% below market for renovated units. To learn more, all you need to do is go to homeinvest.com or click in the description below.